Despite the never-ending stream of bad news and mayhem, the stock market continues to rally from its March 23rd low, which it hit at the height of the current pandemic. Unprecedented federal market support in the form of securities purchases of government securities, mortgage-backed securities, and high-yield corporate debt injected over $2 trillion into the money supply, dramatically supporting the financial markets. Since that time, the stock market has reflected the best possible V-shaped recovery, and recently catapulted the NASDAQ to new highs along with new levels of speculative activity, driven by inexperienced retail investors and momentum-driven machine trading. But recently, darkening clouds are forming around the markets as a new reality begins to dawn on investors and speculators alike. The coming realization that the virus is not going away, and the V-shaped recovery is something akin to a fairy tale conjured by naive imbeciles. In this presentation, I will lay out the facts, independent of wishful thinking and the speculative fantasies. In this video, you will see the grim reality of what is before us, and perhaps knowing this, you can protect yourself and your family from what may be one of the worst financial downturns the world has ever seen. Buckle up your seatbelts, me bucko, and come with me on a journey. The choice is yours. You can take the blue pill and go about your life with your head in the sand in a kind of a dream state. Or you can take the red pill and go down the rabbit hole with me and see the truth. The truth of the stock market trouble ahead. It became clear this week with the announcement that many southern and western states such as Florida, North Carolina, South Carolina, Arizona, Utah, California, and many other states that opened their economies up prematurely now have to walk back their plans as the infection rates skyrocket. This burst the bubble of the most optimistic projections of the trajectory of the pandemic and the related economic impact. Investors now have to factor into their projections a much more pessimistic outlook for the economy than was previously thought. Much of the recent moves were tied to a rosy projection that the economies were opening and economic activity was picking up along with economic growth. 33 states last week recorded a 7-day average of new cases that was higher than their average during the previous 2 weeks, according to the Wall Street Journal's analysis of data from Johns Hopkins University. Ironically, elevated infections and hospitalizations in clusters across America compelled New York, formerly an epicenter of the global pandemic, to implement a quarantine on travelers visiting from Alabama, Arkansas, Arizona, Florida, North Carolina, South Carolina, Washington, Utah, Idaho, and Texas. New York is going to roll out, or is rolling out, a 14-day quarantine protocol in coordination with Connecticut and New Jersey, states that have also seen cases stabilize in recent weeks. The resurgence of the pathogen appeared to be sufficient to cause the White House Coronavirus Task Force, consisting of Vice President Mike Pence and the U.S.'s top public health experts, to hold their first briefing since April 27th. Regardless of how far the affected states will go in terms of further action to stem the rate of infection, it is clear that this development will serve to continue to slow any economic recovery from its depressed levels. Under any scenario you choose to predict, including some recent gains in unemployment, the V-shaped recovery scenario is now officially toast. The unprecedented response from the federal government to the pandemic was to pump trillions of dollars of borrowed money into the economy via its economic recovery plan. The trillions went into the PPP program, massive expansion of unemployment benefits, and various other programs and bailouts for various industries that were dramatically hit by the pandemic. All of the stimulus was accomplished with borrowed money that the government essentially borrowed in the capital markets and injected back into the economy. This tremendous flow of money has masked and in essence hid the true damage that the complete lockdown did to the economy. People were paid to do nothing, and in some cases still are, making more money than they were making when they were working. The latest figures show that over 40 million people are currently unemployed. This figure is probably low since it's based on initial jobless claims and does not include those that were out of work prior to the pandemic, self-employed individuals, or members of the quote gig economy. As a result, the official unemployment rate peaked at around 14%. But we believe that the real number is closer to 25%. These numbers have not been seen since the Great Depression. However, the full effect of this devastation has not been felt because the government money that flowed into the economy has essentially softened the blow and masked what's really going on. Remove this artificial support and the full impact of the economy would be manifested in further economic disruption and much higher numbers. So how long can the government bail out the economy? Well, since it's an election year, we can probably expect more stimulus, but obviously it can't go on forever. And my bet is the policymakers will eventually pull back before the virus is completely eliminated, leaving the economy to continue to languish. While the complete devastation in earnings has already been anticipated in the market for the second quarter, I believe that when the second quarter earnings are actually reported in the coming weeks, the market will be surprised in certain industries. These are industries that have been affected the most negatively by the downturn. What hasn't been factored into stock prices yet is the continuing devastation that will be seen from the continuing resurgence of the virus and its effect on third quarter earnings in the most affected businesses. Once this becomes fully realized by investors, the stock market could take another severe leg downward. I think the conclusion of all this is that the economic effects of the virus will go on longer than anyone has ever predicted. In addition, I think the market has, up to this point, discounted the best possible outcome of a V-shaped recovery. When the full impact of the continuing economic distress is fully factored into stock prices, the market has to eventually go down. It is widely known today that massive quantitative easing, i.e. money printing and buying of securities by the Fed, has led to a bubble in current market valuations. Today, as measured by the Shiller P/E ratio, which is the broad market average, the market is currently trading at a P/E ratio valuation of 29 compared to a 100-year average of just over 17. Professor Robert Shiller of Yale University invented the Shiller P/E ratio to measure the market's valuation. The Shiller P/E is a more meaningful market valuation indicator than just the regular P/E ratio because it eliminates fluctuations of the ratio caused by variations in the profit margins that occur during normal business cycles. This is similar to market valuations based on the ratio of total market cap over GDP, where the variation of profit margins does not play a role there either. In this chart, going back to the 1800s, you can see that the current market valuation of 29, there's only one period when the valuation was higher than today, and that was in the year 2000 during the dot-com bubble, when it hit an astounding level of over 40. You might remember that period didn't end very well either. When you look at the quote Buffett indicator, which is Warren Buffett's favorite valuation measurement, which is the total capitalization of the stock market over the US GDP, which is a measurement of total market cap to the economy's total output, you can see from this chart that its current reading of 146.9% is the highest reading on record, going back to the early 1970s. As pointed out by Warren Buffett, the percentage of total market cap relative to US GDP is, quote, probably the best single measure of where valuations stand at any given moment. Given the backdrop of unquantifiable economic risks associated with the pandemic, this situation is clearly not sustainable. As a result, the risk to the downside is high. Last week, which was the last week in June 2020, the Fed conducted its annual stress test on the banking system. The results of the tests were clear. The current pandemic and resulting job losses and economic destruction went far beyond any of the downside assumptions that were in the existing models. If you project this situation out a year or even 2 years, as some experts predict, the current crisis becomes, by its very nature, a banking crisis. The banking legislation that resulted from the Great Recession, called the Dodd-Frank Act, increased the requirement for capital reserves for banks. It also increased the Tier 1 equity levels and limited some risky activities such as proprietary trading. The results of this was that the banking system going into this crisis was much stronger than previously. That being said, the depth of this crisis will test the limits of banks' balance sheets as real estate and corporate loans alike default and have to be written down and restructured. If the current trend continues and government pulls back on the enormous level of financial support it is giving to zombie companies by buying their debt, the banking system will inevitably take a big hit. The current crisis turning into a banking crisis is something that will initiate a new round of stock market sell-offs, as well as creating lasting damage to the economy. Another major risk that I see to the market, which the quote lamestream media is not reporting or discussing, is the political risk that we face here in an election year. So far, Trump is behind in the polls both nationally and in the major battleground states. Now, it's easy to dismiss these polls because last time Hillary Clinton was ahead in the polls the entire election, only to lose decisively in the Electoral College. Given the recent market rally, the market has reflected its belief that the polls don't mean anything, and the market still believes that Trump will get reelected. This confirms the view that Trump and the Trump presidency has overall been extremely positive for the stock market. Take a look at this chart since Trump has been elected. His policies have been extremely supportive to business, jobs, and the economy, as reflected in the lowest unemployment rates in virtually every demographic and racial group, as well as much higher GDP growth than under the Obama regime, which was generally perceived as resolutely anti-business. A Biden win, which I still think is unlikely, would be disastrous for the stock market. The lunatic left that controls the Democratic Party presently would overwhelm any common sense policies that Biden might have assuming he has any organized thoughts left in his head. He has already positioned himself with a platform to roll back most of Trump's policies relating to corporate taxation, individual taxes, regulation, trade, and has committed to implement all kinds of environmental nonsense, such as the Green New Deal. This reversal of pro-business policies, coupled with a possible Democratic control of the Senate and the House, would combine to quickly implement anti-growth, anti-business policies that would serve to quickly eliminate the current stock market rally. A Biden presidency in his weakened, feeble mental state would effectively put Nancy Pelosi in charge, giving her free rein to implement a woke, left-wing agenda that would be uniformly negative to the stock market. A stock market crash would immediately occur following a Biden win in November. Given the media's extreme bias against Trump and its almost psychotic, unnatural protection of Biden, this is a very real risk to the stock market in the near term. The current crisis and accompanying economic shutdown has caused unprecedented disruption to the economy, the national psyche, the job market, and to people's lives in general. The stock market has made a dramatic comeback since its low of March 23rd due to endless money printing, securities purchases, and massive fiscal stimulus. When the remaining risks are analyzed, as we have done here, the risks suggest to all who will listen, there is stock market trouble ahead. As a footnote to this presentation, I just wanted to say that this is an analysis of the short-term risks that I see in the stock market, going from where we are now to maybe the next 6 months out. This is by no means a prediction of the long-term opportunity, either in the stock market or long-term growth prospects of the U.S. economy. I learned a long time ago, never bet against the United States. We have the best economy, the deepest economy, the most productive economy on earth, and there will always be a bright future for the United States and for the stock market as it reflects there. I believe that everyone should have a permanent exposure to the stock market, as you will over time earn the highest return as it's reflected, as it reflects the economy over the long term. Okay, so if you found value out of this presentation, please like, subscribe, hit the notification bell, and I'm looking forward to giving you some very additional, very good content in the weeks and months to come. Thank you very much, and we'll see you again soon.